Welcome to session 10 of this entire startup money playbook series that we've actually started. So, this particular session is one of the most powerful in your entire financial journey because this is going to help you actually decide so many things. And the name of the session is Financial Ratios. Uh, going to tell you complete, scorecard. So, in this session, we are going to learn how to evaluate any business using just a set of numbers, and these are not opinions, not stories, not assumptions, but these are all backed by data. And you will learn 25 financial ratios across 5 key categories that together form a complete dashboard of any business. So let's quickly understand what these categories are here. Right, you can see certain pointers. Right, first we'll start with the profitability ratios. And one question you can ask is, do they actually make money efficiently? Then we'll talk about the liquidity ratios. So one question for you can be, can they survive in the short term, right? Then we'll study something called the leverage ratios, which is how risky is their financial structure. Then we'll talk about efficiency ratios, how well do they use their resources, and then of course valuation ratios. Okay, so here you can ask this question: what is the market willing to pay, and is it justified? Right, so these ratios, right, together complete the health report of a company. And by the end of the session you will be able to calculate these ratios, compare companies benchmark performance, and most importantly think like an investor. So this is just not theory, this is a real world skill. A founder who understands ratios makes better decisions, avoid hidden risks, and builds stronger companies. So stay focused because the session will change how you look at businesses forever. So let's get started. Yeah. So first of all, we'll just do a quick recap of the last session, what we had. Right, the 5 minute scan. In just 5 minutes, you'll understand 80% of any company's story using 5 key checks. If you may recall, these are revenue growth, gross margin percent, debt to equity ratio, current ratio, and CFO versus net profit. So the idea is simple. Instead of reading everything, you focus on the most important signals first. Then we had the 20 question checklist. Okay. So we use a 20 question checklist. Question 1 to 10, if you may recall, there were 2 slides. First question 1 to 10, they actually focus on the profit and loss statement quality. And the remaining questions, 11 to 20, they focus on the balance sheet and cash flow. And the rule is very clear. If the answer to any question is no, you must investigate further. And the third one is start with cash flow and not P&L. This is the most important idea. Cash flow from operations, CFO, if you remember, is the truth. Net profit is just an opinion. So we can also understand, with this example. So we've been taking Study AI's exam. So Study AI has an accrual ratio of -4%. What does that mean? It means for every 1 rupee of profit, the company is generating real cash backing it. A negative cash accrual ratio indicates that profits are supported by cash, which is a strong signal of financial health, right? So till now, right, you know how to quickly scan financials, but in this particular session, we go deeper. And as mentioned earlier, we'll learn 25 ratios across 5 categories that together form a complete health of any business, right? So from quick scanning to deep analysis, that is the shift we'll make in this session. Okay, so how the session is divided, let's look at that. First, we'll start with the hook as always. We begin with a simple comparison. 2 companies, same ratio, same revenue, right? And but these are very completely different outcomes that you actually see maybe in terms of gross profit, net profit. So you'll actually realize revenue for both the companies is same. Now, one company is thriving and the other company is struggling. right? So the difference will be explained using ratios. So we might take just 60 seconds. Then we'll move on to studying category one, profitability ratios, right? And we'll cover gross margin, net margin, return on equity ROE, return on capital employed ROCE, and EBITDA margin. Now, these five ratios answer one question, and that question is the business making money efficiently? We'll move to category two, which is liquidity ratio, right? And here we'll study current ratio, quick ratio, then cash ratio. And these answer, right, one simple question: can the company pay its bills today? Then we move to leverage ratio. That is, so we'll start with debt to equity, interest coverage, debt to assets. And these answer very simple thing: how risky is the company's financial structure? Then, of course, we'll study efficiency ratio. So you have asset turnover, receivable days, inventory days. And these will answer a very simple question: how well is the company using its resources? Moving on, and at last, it will be all about valuation ratios. So here we'll see P by E, that's price to earnings ratio. In this is at the investor level. Then EV to EBITDA, price to book, right? And these answer a question: what is the market paying, and is it justified? So after this session, right, you'll be able to calculate all 25 key ratios, benchmark them against industry, build a complete ratio scorecard, and compare two companies and explain at least five ratios clearly to any founder, right? So this session is structured step by step from basic understanding to full analysis capability. Okay, right. So this is the introduction slide. As I already mentioned, we'll discuss two companies having same revenue, and one is going to thrive, one dies, and you will have to guess which one, right? The question is, every ratio in this session will answer one question: is the business healthy? Right. So let's start with something very simple. Okay. Uh, Both the companies are doing well, and they're generating a revenue of 100 crore rupees. At first glance, they look exactly the same, but one of them is doing extremely well, and the other one is slow, and it's heading towards trouble. So the question is, what actually tells us the difference? And the answer is very clear: financial ratios. So we'll start with something called revenue. Okay. Let us look at the revenues. Both say very simple, no difference. Now let us look at the gross profit. Now, company A has a profit, let's assume 62%, and company B has a profit 28%. Okay, what does this mean? This means out of every 100 rupees earned, company A keeps 62 after costs. But company B, on the other hand, keeps only 28 rupees. Right? So which company is obviously stronger based on this? It's company A. Now the next one is net margin. Okay. Company A has 18% net margin. Company B has 2%. Obviously, company A earns 18 rupees profit for every 100 rupees that as a revenue that you see. But company B, on the other hand, generates only 2 rupees. Now here there's a massive difference. Okay. Then we'll look at the current ratio. Okay. The company A has 2.8 times the current ratio, and company B has 0.7 times. Now, this tells us something critical, which means company A can easily pay its short-term bills. Okay, can pay off the vendors, can pay off the salaries of people, and of course, they'll have some working capital left as well. But company B cannot. This is a serious warning sign, right? Then we'll see debt to equity ratio. Okay, company A is at 0.3 times. Now, debt to equity, it's very simple. Debt should always be lower, it should be zero, the best case. But it may not be possible for companies, right? But here, if you look at it, it's less than one and much less than one. It's 0.3 times for company A. But for company B, it is actually more than one. It's 4.2 times. So company A has very little debt, but company B is heavily dependent on debt. And this is where company B is extremely risky. Okay. Then we will look at the interest coverage. Company A is at 24 times and company B is at 1.2 times. What does this mean? It means that company A earns 24 times its interest cost, but company B is barely managing to pay interest. So obviously it's very risky. Now comes one of the most important numbers called the cash flow from operations. Company A generates 22 crores. Company B is at negative 8 crore. That means company A is generating real cash. So money is there. But company B is burning cash even with 100 crore revenue. So finally, return on equity, ROE. Company A is at 31%, but company B is at 4%. So for every 100 rupees invested, company A generates rupees 31, but company B generates only rupees 4. Now let's step back and look at the full picture. Same 100 crore rupees revenue, but completely different businesses. Company is profitable, efficient, and cash generating. Company B is weak, risky, and struggling. And this is the key lesson. Revenues tell you the size of a company, but ratios tell you the quality of the business. And that is exactly what we are going to learn going forward. Okay, so let's start with the category 1. And the first question that you may ask is the business making money efficiently, right? So these 5 ratios answer the most important question in every investor's mind. Okay, so what is that? The answer is, let's go one by one. We'll start with the gross margin. And the formula is very simple. You take the revenue, you subtract the COGS, right? Cost of goods sold. And then you divide it by revenue, multiply it by 100. What you get is gross margin in percentage. The benchmark is above 40%. Okay? That's the industry standard. Let's take our example, Study AI. Study AI is at 84.4%, much higher, right? So what does it mean? It means out of every 100 rupees generated, 84.4 is left after the direct costs. Good. Let's talk about EBITDA margin. Right, formula is very simple. EBITDA divided by revenue multiplied by 100. Benchmark is above 15%. In case of Study AI, if you recall, it's 82%. So what does this mean? It means that from 100 rupees revenue, about 82 rupees remains before interest, tax, depreciation, and amortization. Right, this is again very strong. Now from here, let's calculate the net margin. And the formula is very simple. Net profit, right, divided by revenue multiplied by 100. So when you calculate net profit, you have to actually deduct everything. I mean, taxes, right, interest. So benchmark is about 10%. But in case of Study AI, you see it's 80.4, much closer to that 82, right? And this is the actual profit. This is something that the company takes home, distributes among its shareholders. Obviously, in Study AI case, there was one guy, right? So the entire money is actually going to him. Right? Exceptionally high, exceptionally high. Okay. Now let's look at the ROE, that is return on equity. The formula is very simple. You take the net profit and you divide it by shareholders' equity and you multiply it by 100. Okay. Benchmark is above 15%. Here it is actually 61.7% because he actually raised also some capital. Right. So what does it mean? It means for every 100 rupees invested by shareholders, the company is actually generating a profit of 61.7 rupees in profit. Very strong return. Now let us look at something else. That is return on capital employed, ROCE. Okay. And when you talk about ROCE, you don't use EBITDA, you actually use EBIT. Okay. And you divide it by capital employed, the capital that is actually used. Right. And you multiply it by 100. The benchmark is above 12%. Here, in Study AI's case, it's 58.2%. Okay. So obviously, it's very high again, right? Highly efficient. So now, if you understand 2 key concepts, the gap between gross margin and net margin, okay, it's very, very small. That is only 4%. I mean, if we take the case of Study AI, okay. So only rupees 4 out of rupees 100 is going into, operating cash, extremely efficient business. And second, if you calculate ROE and ROCE, they're almost the same. This tells that the company is not using debt to artificially boost returns. It's actually generating the real money, real performance. And if you look at now EBITDA, which is very important because it removes the effect of financing decisions and accounting choices. Okay. And this is why investors use EV divided by EBITDA to actually, compare companies. Now let's step back and look at everything. All five ratios are strong. Okay. This means the business is highly efficient, of high margin, extremely profitable, and that's the key takeaway. Okay. Let's look at this one, the two important areas, that's liquidity and leverage. And I'm not using the term ratios right now. I'm just using the first term. Please assume that when I'm using these terms, I'm referring to actually the ratios. Okay. First, we'll talk about liquidity, which means liquidity ratio. Now, this answers one simple question. Can the company pay its bills right now? Okay. So look, let's just calculate everything. First, start with current ratio. How do you calculate current ratio? Obviously, you take the current assets and you divide it by current liabilities. That's how we do that. Okay. In case of study AI, we saw how much? 2.12 times. The benchmark is usually between 1.5 to 3 times. So it's much better. This means, right, for a rupee, for every 1 rupee, every rupee of short-term liability, the company has 2.12 of assets. So there is a liability like rupee 1, if right, they have to pay, but they also have assets of 2.12, so they can easily actually pay. Clearly says that they're very comfortable paying its bills. The second ratio here is the quick ratio. How do you calculate the quick ratio? You take the current assets and subtract inventory from that. Okay, whatever is inventory, and you divide it by the current liabilities. Okay, all you have to do is take the current asset, subtract the inventory. Benchmark is above 1 time. In case of study AI, because the inventory is 0, the answer will be the same current ratio, that is 2.12 time. Okay. So that shows that it's a digital business, can be scaled, and here it's successful, right? Okay. So very strong position. Now the third one is the cash ratio. You take the cash and divide by current liabilities. The benchmark is 0.5 times. Here it is 1.89 times. Much stronger here, right? This means even if we consider only cash, the company has 1.89 for every 1 rupee of liability. So close to 2 rupees. So they're just double kind of, right? So very easily they're able to pay the debts if they have. So very strong liquidity. Then comes the leverage. And this answers a question, how risky is the company's financial structure? Okay. So from here, you just take these ratios. You first take the debt to equity ratio. And the formula is you take the total debt and divide it by shareholders' equity. Benchmark is it should be below 2 times. Okay. Right. And here we have 0.15 times. This means it's a very low debt. The company is not dependent on borrowing. Take the interest coverage ratio. How do you do that? You calculate EBIT and you divide it by interest expense. The benchmark is above 3 times. In case of study AI, it's above 100 times. This means that the company earns more than 100 times its interest obligation. Okay, there's no practically any risk or of default. Okay, then comes the debt to assets ratio. So total debts divided by total assets, that's the formula. The benchmark is 0.5 times. It should be below here, right? And for study AI, it's 0.13 times. So what does it mean? It means that it's only 13% of the assets that are funded by debt. Okay. 13% of assets are funded by debt. So if you've taken loan, you've not used the full one, right? Only 13%. So it's again very safe. Let's step back. Okay. Study AI has strong liquidity, very low debt, extremely high interest coverage. What does this mean? It means that it's a low risk business. And because of that, right, it is in a very strong position of fundraising and growth. Okay. Now we move to efficiency ratio. So this category answers one, key question. How well is the business using its resources? Okay. We'll start first with the asset turnover. The formula is very simple. You take the revenue and you divide it by total assets. The benchmark is it should be 0.5 times, right? In case of study A, it's 1.12 times. Okay. When you start working out all these things in your own way, you'll be able to remember these ratios. Okay. Currently, it would be like, oh, 25 ratios. How will I remember? Just try to also look at the terminologies. Asset turnover. Okay. So take the revenue, divide by total assets. Okay. So for every business, rupee 1 of assets, right? The company generates 1.12 revenue. Okay. So the assets are being used efficiently. So company is generating more revenue. Then there's something called receivable days. Okay. The formula is very simple. Take the receivables and divide by revenue, right? And multiply it by 365 because receivables can come throughout the year. Okay. Study AI is at approximate 3 days. Okay. So you know that if larger that figure, which means that you are taking more time to get back your money, which is bad. So study AI takes only 3 days at max to get back the money from the customer. Okay, so that's very good. It's a fast collection. Then comes the inventory days. Formula is very simple again. Inventory divided by cost of goods sold and multiplied by 365. Okay, so study A shows not applicable because there is no inventory. It's a digital business. Then comes payable days. Okay, now payables should be divided by cost of goods sold multiplied by 365 days. Benchmark is typically 30 to 60 days. In case of study A, it's 28 days. That means the company pays its suppliers in about 28 days, within a month, finishes off. Okay. Now, the most important metric is cash conversion cycle. The formula is receivable days plus inventory days minus payable days. So take the receivable and inventory. Okay. You add them and you subtract this payable days. Okay. So in case of study A, receivable days 3. Inventory days, there's no inventory, 0. Payable days, 24. Okay. What you get is minus 25 days. That gives a cash conversion cycle of negative 25 days. What does this mean? A negative number is ideal. It means the company receives cash before it pays its suppliers. Okay. So effectively, operations are being funded by the business itself. So this is one metric where you can actually understand whether you have money or at what point in time you're going to get money so that you can pay off your bills. Right. So no extra working capital is actually required here. Now, this is the same model used by companies like Amazon, where customers pay first and suppliers are paid later. So what do we conclude? We conclude that Study AI has high asset efficiency, fast collections, no inventory, and a negative cash cycle. Okay, which means the business is extremely efficient in managing its operations, world class. Okay, and that's the key takeaway. Now, here we will move to the final category that is called the valuation ratios. Okay, so simple question, as I mentioned, you may recall, what is the market paying for this business and is it justified? So we'll go one by one. First, price to earnings ratio, that is P over E. Formula is very simple. Take the market price and you divide it by earnings per share. Now, typical benchmark is 15 to 25 times. A higher PE means the market expects future growth. Okay. Next, EV to EBITDA. Formula is enterprise value divided by EBITDA. The typical range is 8 to 15 times, and this is widely used in mergers and acquisitions because it removes the impact of debt and tax. Okay. And the last one is here, that is price to book ratio, that is P by B. And here we use market capitalization. Okay. Market cap in short, what you call, and you divide it by the book value. Okay. How do you calculate market capitalization? You take the price of one share and multiply it by the total number of shares. Okay. So typical range is 1 to 5 times. For digital and software companies, this can go even higher, even 10 times or more. Right. So EV to revenue is very simple. Take the enterprise value, divide it by revenue, 1 to 5 times. For the highest growth startups can go from 5 to 20 times or more. So you can take a value, divide by anything, and just see if it is making sense. Like, for example, you can do EV to free cash flow. Okay. Take the EV, divide by free cash flow. The typical range will be 20 to 40 times. And this is considered one of the most honest metrics because it reflects real cash generation. In case of study AI, right, the investment is 75 lakhs for 30% equity. So the valuation is, take the 75, divide by 30%, that is 2.5 crore. Okay, this is where we calculated. Now let's look at the ratio EV to revenue. So enterprise value, because 75 lakh was funded, will be now 2.5 crore, right? And the revenue is 53.8 lakh. If you divide it 2.5 crore by 53.8, it's actually what you're getting is 250. So what you have to do is you can convert this 2.5 crore into lakhs and you will get it 250 lakh. And when you divide, you'll get 4.6 times. So which is 4.6 times. This is reasonable for early stage SaaS companies. Then you take the EV and divide by EBITDA, which is 2.5 crore divided by 44 lakhs, right? Which will be 5.7 times, considered very cheap, especially with such high margins. Okay. Then you take the EV and you divide it by free cash flow. Okay. And free cash flow is 44.6 lakh. What you're going to get is 5.6 times, extremely strong, because cash flow is almost equal to EBITDA. Okay. So the final insight is study A is valued at 2.5 crore because, right, at 30% dilution, they've taken what is that? 75 lakhs, right? And all valuation ratios are in a reasonable or in attractive range. This means that the business is not overpriced. In fact, it looks undervalued given its strong profitability and cash flow. So valuation is not just about numbers, it's about connecting numbers to performance. And here the numbers clearly support the valuation. We will have a complete session on this. Okay, so let's bring together everything, right? This is what you see, the complete ratio dashboard for study year 2, all 25 ratios across all 5 categories, right? If you talk about the profitability, all 5 out of 5 are very strong. Gross margin 84.4, net margin 80.4, EBITDA 82%, ROE, return on equity, if you remember, right? It is 61.7%. And ROCE, return on capital employed, 58.2%. Okay, very high returns and excellent returns. Then let us look at the liquidity. All 3 of them are very strong. Cash ratio 2.12 times. Okay, then quick ratio is 2.12 times. Cash ratio is 1.89 times. This means that the company has strong short-term stability. Okay, then you can have leverage. All 3 out of 3 ratios are strong. So debt to equity is 0.15 times. Interest coverage is over 100 times. Debt to assets is 0.13 times, which means that very low debt and minimal financial risk. Efficiencies, 4 out of 5 ratios are actually very strong. For example, if you take the asset turnover, it's 1.12 times. Receivables is 3 days. Cash conversion cycle is minus 25 days. Payables days is 28 days. Inventory is not applicable as, right? So it means very efficient operations and strong cash management. Okay. And then we will look at the valuation. At seed stage, valuation appears fair. EV to revenue is 4.6. EV to EBITDA is 5.7 and EV to free cash flow is 5.6. The implied valuation is 2.5 crore rupees based on 75 lakh for 30% equity. So what will be our final verdict? Exceptionally healthy, right? This is a digital SaaS business with high margins, strong cash generation, almost no debt. Okay. Completely investor ready business, right? So strong across all dimensions, no major weakness, right? Clear fundamentals, right? Now we move to a very important idea, that is context is everything. Okay. A ratio by itself means nothing. If only it only actually makes sense when you compare it to the right industry. Let's understand this with examples. Digital or SaaS first, right? So gross margin is typically 70 to 90%. Net margin is 20 to 40%. This in general we're talking about. And then debt to equity is usually below 0.5 times. Current ratio is between 2.4 times. Why? Because these businesses are very low direct costs and benefit from scale. Take the case of FMCG. The gross margin is 40 to 55%, net margin is 8 to 15%, debt to equity is 0.5 to 1.5 times, current ratio is 1.5 to 2.5 times. What is that reason? Because of the high distribution costs and branding expenses. In terms of manufacturing, if you look at gross margin is 25 to 40%, net margin is 5 to 12%, debt to equity is 1 to 2.5%, current ratio is 1.2 to 2 times. This is due to high capital investment and raw material costs. Take the banking or NBFC, non-banking, financial institutions, if you look at that way, companies. So gross margin is not used here. Instead, we will look at the net margin, net interest margin. Okay. So debt to equity is very high, around 8 to 12 times. Okay. This is normal because lending itself is a business model. In terms of pharma, if you look at gross margin is 55 to 7%. Net margin is 12 to 22%. Debt to equity is 0.3 to 1 times. Current ratio is 2 to 3 times. Why? Because it's driven by research and development costs and patent value. Take the example of restaurant and food and beverage. Okay. So gross margin is 60 to 70%. Net margin is very, very low, which is 3 to 8%. Debt to equity is 0.5 to 1.5 times. Current ratio is 0.8 to 1.5 times. Okay. Labor cost is very high. Rental costs are actually high. Right. That's the reason. Take the EdTech study AI. It is gross margin is 84.4%. I mean, here we have actually read all. Net margin is 80.4%. Debt to equity is 0.15. Current ratio is 2.12. So this reflects a pure digital model with no physical cost structure. So the final rule is never judge a ratio in isolation. A number that looks bad in one industry may completely be normal in another, right? For example, a debt to equity of 10 times is disastrous for a software company but normal for a bank. Similarly, a current ratio of 0.8 is risky for manufacturing, but maybe acceptable it's actually acceptable in restaurants. Okay, so always compare, always benchmark, and always interpret in the right context. Now, if you track only a few things, these are the 5 ones, right? These are your core health indicators. First one is the gross margin percentage, and the formula we have already discussed several times: revenue minus COGS divided by revenue. This tells you into 100, of course, when we talk about margin percentage. This tells you how strong your unit economics are. If gross margin drops without a clear reason, your business is actually weakening. So the target is know your benchmark and do not let it drift. Now, net profit margin. The formula is net profit you divide by revenue, and this is your bottom line check. Gross margin is stable, but net margin is falling. It means your operating costs are increasing. You need to find the leak. The target is margins should improve as you scale. Now, if they fall, you have a cost problem. Now, operating cash flow, right? CFO. Now, this comes directly from the cash flow statement. It's not a ratio, but it is the most important number. If cash flow does not match net profit, you must investigate immediately. Take the target, right, which is CFO should be equal to or higher than net profit. And if CFO is negative, that's a serious warning. The next one is the current ratio. Formula is very simple. Current assets divided by current liabilities. This is your short-term survival ratio. If it is below 1, you cannot pay your bills. Keep it above 1.5 times. And if it falls below 1.2, take immediate action. Then you may recall our LTV, lifetime value, and CAC. So lifetime value to CAC, okay, customer acquisition cost. The formula is very simple. You divide like LTV by CAC. Right. What this tells you is if your growth model is sustainable, and if this falls below 3 times, your customer acquisition is not working. Minimum is 3 times and healthy is 5 times. In case of study AI, it is actually 76 times, and this is a world-class performance. So the final rule is very simple. Track these 5 ratios every single month. If any of them moves negatively for 2 consecutive months, stop everything and diagnose the issue. So problems don't appear suddenly. They show up in ratios first. So we'll do a quick recap. Okay. Point one is 25 ratios across 5 categories. You've now understood the 25 financial ratios grouped in 5 categories: profitability, liquidity, leverage, efficiency, and valuation. Together, these form a complete health card for your business. The second point is context determines meaning. A ratio alone has no meaning. It must always be compared with industry benchmarks, right? Debt to equity of 10 times is dangerous for a software company, but it's normal for a bank. Okay. So take the case of then point three, study AI scores green on all 25. Okay. We have seen exceptional profitability, strong liquidity, minimum leverage, efficient operations, and fair valuation. So this business is investor ready. And the fourth point is track all 5 ratios every month. Gross margin percentage, net profit margin, operating cash flow, current ratio, and LTV to CAC. Track these consistently. If any of them declines for 2 months in a row, you have to take serious action. So you now have a complete framework to understand and evaluate any business. Yes. So what you need to do, right, for this week is build a ratio dashboard for a real company. Okay. Go to screener.in, pick any two Indian, listed companies from that same sector. For example, take Nykaa and Mama Earth, Zomato, and similar company, Info Edge or maybe India Mart. Do that. So download their last full year financials. Now calculate all 5 profitability ratios for both companies. Next, you calculate liquidity and leverage ratios and ask yourself this question: which company is safer and which one has more debt? Then you calculate efficiency ratios. Compare who uses assets better and who collects cash faster. Then look up valuation multiples, right? You can use Tijori Finance also, right? And ask this question: is the valuation justified based on fundamentals? Finally, write a 5-line analyst verdict. Okay. Ask this question: which company is stronger and why? And bring this to the next session. It's very simple, right? You should use this template T9, which is there. You can just take any of the previous videos and download from them. It includes actually all 25 ratios auto calculated, a 2 company comparison view, industry benchmark lookup, and traffic light scoring. So, what is the ratio tip of the week? The most dangerous number to ignore is the operating cash flow. Experienced founders check this weekly because every financial manipulation eventually shows up as a gap between net profit and CFO. So, very simple. If you want to think like an analyst, you must practice like him or her. Okay. So, next we will have burn rate and runway. And this is where finance becomes survival, right? You will understand between the difference between, what you spend every month and what you actually lose, because not all expenses impact your runway equally, right? You will learn the exact formula to calculate runway, not roughly, but precisely. So you always know how many months your startup can have. And the next is 3 ways to extend your runway without raising new capital. You can still increase capital, survival time. So you will learn how to reduce burn, increase revenues, and increase collect receivables faster. So hope you like this session, and right, you will know exactly how long your startup can actually survive and how to extend this. With this, we come to an end of session number 10. You can now very well evaluate any business using 25 financial ratios under 30 minutes. Remember one important rule: ratios without benchmarks are meaningless. We've already discussed. Always compare, always interpret in context, always remember this. We started with two companies with same revenue and see one was really healthier and one was just declining. Okay. And finally, of course, track 5 ratios every month: gross profit percentage, net profit margin, operating cash flow, current ratio, LTV to CAC. If any of them drops for 2 consecutive months, you must take the immediate action. Numbers don't lie, but only if you know how to read them. Thank you so much for watching. Do like and subscribe. See you in session 11.